Some key points today. There are two competing concepts of income that one might apply in a tax system. They differ as to their treatment of the time value of money, and an important concept in sorting through their differences is present value. We're going to be talking about expensing versus depreciation. And we're going to talk about how to tax interest because questions about that keep coming up in different tax plans. The two basic concepts of income are income is the change in your ability to consume during a year. It includes whatever you're earning this year on your labor income. It includes the savings and investment returns you may be getting on income that you saved in the past. It includes capital gains as they accrue. We don't wait in this concept of income until you take the gain. And it assumes something called economic depreciation, which I'll get to in a little bit. These rules as to what constitute income make no adjustment for the time value of money. And this is the tax system that was proposed by Haig and Simons back in the 1940s. It leads to what you would call a pure income tax. Now, our income tax isn't pure. We let you wait to take your capital gains before we tax them, and there's some other things going on, like accelerated depreciation. But basically, this is the intellectual heart of the income tax. It's what's taught in law school, and many of your members have had this definition at one time or another, and it's kind of the way a lot of people normally think about it if they're in the legislative process. It's not the most common sense definition of income for the layman. That would be something else. It would be revenue less the cost of earning the revenue, or in other words, profit. Labor income would be taxed, earnings on saving and investment would be taxed, but only after the immediate expensing of all of the costs of earning the income, including purchases of machines and buildings and materials. And if you regard education as a cost of earning future income, you have more money after you graduate from college as you earn than if you don't, and so on. There are also many courses you can take while you're working to get a bump in salary, and then there's technical training. So tuition and training expenses might be deductible. This definition of income is called cash flow, and it reflects the time value of money, and it was proposed by, advocated by Professor Fisher here and some professors in Britain. It leads to a saving consumption neutral tax, and we'll sort through that in a minute. This is a quick refresher. Remember, our model is driven by the counting up of the total amount of labor and capital. They go to work, they produce something, and it is sold. We count GDP, or national income, in two ways. You can add up all the things that are sold, all the haircuts, all the cab rides, all the appendectomies, all of the steel that's put into the cars. The car is the final sale. You count the cars, not the steel. You'd count it twice. And all of the things that we buy and sell, the clothing we buy, the rent we pay, and so on. That's GDP. Or you can count, as those things are sold, all of the money that is going from right to left. As the firm sells the product, it pays its labor, and it pays for the rent on its capital, it pays its shareholders, it pays its mom and pop grocery store owners their return on their capital. And you can count up all of those income receipts, and they equal all of the sales prices. Money has to go somewhere. Of course, the government steps in and takes some and then spends some and so on, but basically that's the flow. Products, left to right, payments for the products, right to left. They're equal. You can look at GDP either way, and we do. The Commerce Department adds up all of the incomes, and it also adds up all of the sales. And then there's a little statistical discrepancy because a few things might be off the books, but that's basically two equal measures of GDP. And the reason I bring this up again is we're going to be talking about the cost side of things today and how you need to deduct your costs before this revenue stream is actually profit. So, how do we deduct the costs of plant and equipment and buildings and other things that you might buy, the cars for your fleet, the planes for your fleet? There are several ways of looking at it. One is called economic depreciation. That's what you learn in law school. It's the reduction in the value of the asset year by year as you hold it, and it becomes obsolete and it wears out and you couldn't resell it for very much more later. And they say that's your only real loss. Then there's straight line depreciation. that says, well, if it's a $100 machine, if it's expected to last 5 years, we'll take off $20 a year for 5 years. Then there's accelerated depreciation, which says, no, let's take a little bit more off sooner and a little bit less off later. So your first year, you might get a $30 deduction, and then maybe $25 the next year, and then the smaller pieces come later on. You know how you buy the car and you drive it off a lot, you change your mind, you drive it back, and you said, buy it back for me, and they said, well, it's depreciated a full year, you're only going to get 80% of what you just paid us 5 minutes ago. That's part of what accelerated depreciation takes account of. Then there's expensing, which is the immediate write-off of the full cost of the asset, which means that you know that you're getting the present value equal to the 100 cents on the dollar of what you just purchased. So profit is revenue less the cost of earning income. You have to deduct the costs. There are two basic approaches: cash flow, which is expensing, and depreciation at various paces, which is the other way of doing it. How long should you stretch out your write-offs? The rationale for straight-line depreciation is based on the resale value of the asset. If I bought it for $100 and I can sell it for $80 a year from now, I've only lost $20 in value. If I could sell it for $60 2 years from now, I've only lost $40 in value. I've lost $20 a year under this particular illustration, and so that's what Hagen-Simons would have you write off as your loss of income in the year from using the machine. The problem with it, of course, is if you're going to buy a $100 machine, you can't buy it in slices. You have to buy it up front. And if you've tied your money up in it, you have a loss going on of the loss of the money for the year, and that is not reflected in this economic depreciation notion. The other problem with economic depreciation is that we can't measure it. A conveyor belt in a coal company and a conveyor belt in the fuzzy pink bunny slipper company, they're going to wear out at different rates, right? And it's very hard for the Treasury to know exactly what life to assign to each of those and how much it's deteriorating year to year to year. It may surprise you to know that the original deductions for buildings, which we knew to be, well, there's very little damage the first few years, but as you get older, there's this tailing off of value. They didn't know how to measure that in the 20s and 30s, so Mr. Wyckoff went out and did a survey of long-lived assets, and the asset he picked was telegraph poles. And so we know the rate of decay of telegraph poles and how many are knocked down by storms the first year. And so they said, well, let's apply that to office buildings and malls and skyscrapers and everything else. It didn't really quite fit the facts, but these arbitrary rules are what govern our depreciation schedules. Well, let's look at depreciation versus expensing. I picked 3 assets: a 3-year asset, a 7-year asset, and a 39-year asset. Your computer, your typical machine in a factory, or your building under current law. And if you expensed $1 expenditure on one of these assets, the value of it up front to you in present value would be $1 in each case. Under the current maker's depreciation system, modified accelerated cost recovery and no inflation, the 3-year asset's value, the value of the write-off, is only about 96 cents when you discount it at a 3.5% real discount rate plus inflation. The 7-year asset has a write-off which is only worth about 91 cents on the dollar, and the building only about 55 cents on the dollar. As inflation gets worse, of course, the value of the write-off declines further. The 3-year asset falls to 92 cents, the 7-year asset to 81, and the 39-year asset falls to 30 cents. That means, according to the tax schedule, over the life of the building only cost 30 cents for every dollar you spent on it. Its return revenue stream begins to become taxable 70 cents too early. So you're overstating the real value of the returns on the building, and in effect, the 35% tax rate is on something more than their real income, therefore the effective rate is much higher. In the 1970s, after the oil shock, when we started having periods of double-digit inflation, many companies using the allowed depreciation schedules were in fact losing money if you factored in the fact they had to replace their assets at a certain inflated price, and they weren't allowed to deduct the true value of what was going on with their depreciation. And they were reporting taxable profit when they were in fact losing money. I was on the Capitol Hill staff at that time, and I was working on indexing the income tax brackets, which eventually happened. And we were thinking about indexing depreciation for inflation. And I asked Charles Schultz, who was the chairman of the Council of Advisors at the time, under President Carter, I said, shouldn't we be doing this? Professor Feldstein just calculated that umpteen companies were losing money and paying tax nonetheless. He said, well, that's theoretically correct, but we have the deficit, and we probably wouldn't endorse that, but theoretically it's correct. There were two other people on his panel. One was a steel executive, and one was running a Northeastern utility. And the Northeastern utility president said, oh, I don't want replacement cost depreciation. And the steel man said, why not? He said, because if our shareholders ever found out that we're really losing money, they'd have my head on a platter. Well, the steel man just sneered at him and said, and what has happened to your stock price in the last 18 months? It had tanked. Every stock analyst knew the company was losing money, and they were telling the brokers who were telling the shareholders who were selling accordingly. Who was he fooling? Anyway, this is a real problem. If you simply lower tax rates, you're not adjusting the problem that we have with the depreciation, which affects capital-intensive industries more than other industries, and which affects capital-intensive industries with long-lived assets more than companies with short-lived assets. Over the last 20 or 30 years, we've had a lot of investment in more and more short-lived assets, more into the computers and less into the real estate and less into the office buildings and less into the steel mills and less into the railroad tunnels, which last for a very long time. And we're shifting the mix of our capital, partly because of the tax treatment. Now, present value is quite simple. $1 today and $1 5 years from now are not the same thing. Here I've used a 5% discount rate. Suppose you buy a $1,000 cash register and you write it off at $200 a year. The value of the write-offs falls from $200 to $190 to $181 to $173 and so forth. You've written off a total of $909 in present value when the machine cost you $1,000. You've overstated your income, understated your cost by that much. If you wanted to correct that, there's a way of doing it. Well, there are two ways. One, you could say, write it off the first year, get your full $1,000. That's expensing. The other way is, well, we don't want to give you that big a write-off right away because of the 10-year budget window and this and that. Why don't we just augment your write-offs each year for the time value of the money? So the first year you'd write off $200, the next year $210, the next year $221, and so forth. Your total write-offs would be $1,106, but in present value would be equal to the $1,000 up front. So either way gets you the full value of your cost acknowledged by the tax system. So present value is important on the depreciation allowances. It's also important for savers. If I have money in the bank and I'm earning interest on it, that interest is in part compensating me for waiting, for the fact that over time that money is becoming less valuable to me in the future. And that portion of the interest that merely compensates me for the time value of money isn't really additional psychic income to me. The tax man says it's income, but I don't feel like it. Only if the interest rate is high enough to exceed my time value of money do I sense an increase in return. Now, why does that matter? People are born with a sense, well, they're not born with it, they develop a sense of time as they get older. If you ask a 2-year-old, would you like an ice cream cone today or 2 ice cream cones tomorrow, he'll grab the ice cream cone and have it all over himself before you even finish the sentence. But if you ask a 4-year-old, the wheels begin to turn and some of them will say, I'm going to wait for the 2 ice cream cones tomorrow. The time sense is very real, and it appears from the data, going back a century or more, it's about 3%. More than 3%, you tend to wait and do whatever you're going to do with the money and invest it and save it. If it's less than 3%, well, might as well consume it today. So it does make a difference, and a tax system that acknowledges the time value of money and doesn't tax it does less to alter your behavior than a tax system which does ignore the time value of money and treats it as additional income when you don't think it is. If we were to switch from straight line depreciation to expensing, there would be an increase in write-offs at the beginning of the transition. This is just a simple diagram which assumes you have 5-year assets and you're writing them off 20% a year and you bought one every year in the last 5 years. So in each year, year 0, you're writing off a fifth of each of these machines, the one you just bought, the one you bought last year, and so on all the way back. Now next year, one of them drops out. It's expired, it's been retired, and you're writing off 4 pieces of old assets, but now we're going to let you write off all of the new one. You see, the write-off goes up for a period of time, but as the old stuff drops out, we go back to roughly the same amount of write-off as was the case in year 1. Some people argue that that means after the transition, the revenues are about where they were for the government, and the write-offs are about where they were for the business, and so the business going forward still has the same amount of write-offs. What's the big deal? Well, the big deal is that depreciation schedule I showed you earlier in the table, which said the value of the write-offs has declined for the asset because of the inflation and the time. Going forward, every new asset now under this system gets immediate write-off and is more valuable than it used to be back when you had to wait. So even though the write-off goes back to about what it was when you started, each new machine that you might add to your business, each new factory that you might open, looks better and yields a higher return in present value to the investor than under the old system. So they're not the same situations. Going the other way, if you switch from accelerated depreciation or expensing to straight line, you initially get a drop in the allowable write-off. The new asset can suddenly only write off 20% of itself instead of all of it. The next year, you're still writing that one off, and you can write off a piece of the new one, and so on. And eventually, the write-offs climb back up to where they were. Meanwhile, there's a sort of bulge in revenue for the government because you have temporarily delayed the cost recovery. If you look in an accounting textbook, it'll say this is only a matter of timing, doesn't matter in the long run. But that doesn't count present value. Because when you get out to year 5 here, you are now seeing that anything new that I buy has to be written off over 5 years instead of all at once. Its return is going to be lower. Its yield is going to be lower. It's going to be less attractive. And businesses will not be buying as much investment equipment, investment goods, buildings, machines in the new system as they would have in the old system. So this argument assumes they're going to continue to do what they were doing before without paying any attention to the time value of money. This approach was used by the British when they lowered their income tax on the corporations. They had been at expensing and they went to depreciation and they stopped writing off buildings altogether. You had to eat your building. You couldn't count it as a cost. The south of England, the financial center of London, did great at the lower corporate tax rate. The north, the Midlands, and Scotland, with the heavy industries, didn't gain as much at all. And you've got some interesting political repercussions in Scotland, which almost voted for independence a couple of years back. I think it was partly due to their tax reform. Anyway, the Camp plan tried this. It lengthened asset lives and lowered the corporate rate. And when we modeled it, we found that the cost of plant and equipment had actually gone up because they took a bigger hit from the depreciation change than they gained from the rate reduction. In part because the rate reduction doesn't fall only on capital spending, it falls on managerial talent, patents, royalties, it falls on advertising, it falls on whatever brand loyalty they may have had or any better mousetrap they might have built. These special things that give them an abnormal return get part of the corporate rate reduction. The actual purchase of the machines has to share that benefit with all the other parts of the company, and it gets hurt in this trade-off. So we showed it as an increase in the cost of capital, which meant less capital, which meant less output. So the income gains from lowering the rate in that plan would have been offset by the output loss from having a worse treatment of plant and equipment. I don't think we were believed when we said this to the committee staff, but when the Joint Tax Committee came out with its report, it said the same thing, and they said, oh, okay. Well, we've modeled a switch to going to expensing, and we conclude that the depreciation as a percent of GDP would go up substantially in the first year, because now you're deducting immediately all the new investment. But as the old investment that you're continuing to depreciate gets old and vanishes, of course, the cost comes back down. In fact, depreciation allowances are currently around 9% of GDP, and under expensing, they'd go up to about 11. Because the economy is growing and there's more and more investment each year, and it makes a bit of a difference in the long run But basically, that couple of percent is really what we are denying people in the current system. And so the cost to the budget of expensing, of the switch to expensing, which is substantial in the short run, becomes much lower in the long run. We have shown here in this graph the static revenue estimate versus baseline revenue according to the CBO's projection of baseline revenues. That is the purple line. The dynamic revenue, after accounting for the added capital being formed over time, it's not instantaneous, takes you from an initial hit to revenue up toward break even in about the 7th year and a gain thereafter. That's the top blue line. The green line in the middle counts for the added interest outlay you might have if you borrow the money in the first 7 years to cover the temporary revenue shortfall. So that's a little bit lower, but you're still actually getting into surplus territory for the tax provision by the, I guess, the 8th year. One of the reasons for including it in the blueprint, I think, is that they were willing to take the budget hit in the first years to have the surpluses out further so as not to run afoul of the Byrd rule in the Senate, which says your tax bill, if it's to be permanent, can't damage the budget outlook beyond the 10th year or beyond the end of the budget window. This isn't the only provision of the bill, so there are other things that cost revenue going forward. And of course, joint tax doesn't always do a full dynamic score of a bill unless they're asked to. They would be asked to in the case of the blueprint. But for reasons we will get into next week, their model is not as robust in showing growth as ours is, primarily, I think, because of their treatment of the Federal Reserve and the financial sector and interest rates and crowding out. We model this particular provision as increasing the debt initially and then reducing it later as the surpluses come in. We also compare it to the cut in the corporate rate that you could finance by switching, that would be happening by having the same static 10-year revenue loss as the expensing. It also generates growth, not quite enough to cover its cost after you take the interest cost of the first few years into account, and it shows a deeper static loss going forward. It does generate growth. It doesn't generate quite as much growth as the expensing. Now, we often hear that one group of companies wants a corporate rate cut and another group of companies wants expensing. And they have two coalitions that are dueling, like dueling banjos, and they don't get together. Something to note about both of these provisions. If you have either one of them in place, the other one gets cheaper. If the tax rate's lower to begin with, it doesn't cost you as much to speed up the write-offs for depreciation because you're deducting them against a lower tax rate. If you have the expensing, you're showing less taxable income to begin with, and lowering the rate doesn't cost as much. So each of those charts is if we did it alone. If you did them together, it would look better. Now, why do some companies prefer one over the other? If you are a law firm or an architectural firm or a service firm, and if you are incorporated, some of them are pass-through companies, but if you're not, if you're a service company, you don't have much plant and equipment, so you care more about the rate. If you are rich in royalty income and R&D, you're not writing off a steel mill or a railroad tunnel, so you care about the rate. If you are writing off the railroad tunnel or the steel mill, you care about the expensing provision. So you have these competing views. If you are a manufacturing company, but you manufacture offshore, some of the tech companies do their R&D here, but they manufacture the consumer electronics offshore. They're more concerned about the US tax rate, not the write-off of the manufacturing facilities in another country. So all of this affects people's rationale. The other effect is the thing I mentioned about how we report expensing on your income statement. When you cut the corporate rate, it shows up as an immediate increase in projected revenue, and the accountant tells you under generally accepted accounting principles, GAAP, that you now can show your shareholders an improved bottom line. But if we accelerate depreciation, and the accountant is taught that only economic depreciation is legitimate or straight line depreciation is legitimate, they make you do something peculiar on your income statement. Okay, I got more write-off this year than I would have under our, quote, normal pattern, and that shows up as a gain this year, but you're going to owe more tax later because you took your write-off sooner and didn't get it later. So we make you put down something called a deferred tax liability. And they do it dollar for dollar. So if I save $1 on depreciation because of the acceleration today, they take $1 and say, no, that's a deferred tax liability, you're going to owe it later. And +1 and -1 equal 0, no improvement in your bottom line. They don't discount the fact that it's going to be delayed to show that it is of less burden 5 years from now than immediately. These are accountants who are very good with numbers, and they don't discount. They don't take a present value of the write-off. Well, they don't know when you're going to be paying the tax. They don't know what your income's going to be out there and whether you can take your full write-off and when it's going to be, and they don't know when the tax is going to happen, so they just do it dollar for dollar. Some CEOs, and I mentioned one just a few minutes ago who was worried about the appearance at the shareholder meeting of his loss, would prefer to have the income tax cut because they can march to the front of the podium at the annual meeting and say, our bottom line went up, but if you give them the accelerated depreciation, which may actually be more valuable to the company, they can't show an increase in the bottom line. So they don't like that as much. And there are people like that. That's not what's best for the shareholder. My attitude is if you want a better bottom line, go to the gym and do some squats, but don't hurt your shareholders by accepting a worse tax outcome than a better one for your company. I was going over this with 3 members of Congress a couple of years ago. One of them was Steve Scalise, whom we all hope is doing well. But there were 2 other members there, and I went over this quirk that the accountants promulgate, and I made fun of it. And I suddenly remembered something. One of the people I was briefing was Lynn Jenkins, the gentlewoman from Kansas, who in her real life is an accounting major. And I thought, how much trouble am I in? And I looked up at her, and she was grinning from ear to ear and nodding her head. She was also an economics minor, you see. So she knew exactly what I was talking about and agreed with me. Anyway, there we are. The corporate rate will raise the debt. Corporate rate reduction will raise the debt, then bring it down again a bit, but longer term it will not quite cover its cost, but it's still very much worth doing. One other thing I want to mention about the tax treatment of some of these elements of taxable income involves interest. And I'm going to tell you this because we've recently talked with some people who are in positions of influence on the tax reform front, and they are concerned about some of the elements of how you tax interest in the presence of accelerated depreciation, which becomes even more important when you're going to full expensing. Companies have the write-off for the machine bigger and earlier in their lives. For some companies that are investing a lot or are just starting up, they don't have all that much revenue coming in, and these write-offs might be very large relative to their revenue, might even exceed it. You might end up with a net operating loss for a period of time. And the House bill takes care of this with its expensing provision in a very clever way. It says, okay, right now you can carry your losses forward 20 years and then they expire. We won't expire them. If you have to wait longer to recover your full upfront costs, you may do so. Furthermore, we are going to pay you the interest on the delay so that the present value is maintained. So the net operating loss issue with expensing is mitigated, if not totally done away with, by that provision of the House bill. Many business people I talk to don't know that provision is in the blueprint, and they think, I'll have net operating losses, it won't do me any good. And joint tax normally scores a provision that ends up being sucked into net operating losses as not doing a company much good right now. But the blueprint preserves the value of it over time. They need to model it differently from the ordinary acceleration provision that's outside the scope of the blueprint that doesn't have the adjustment attached to it. The other thing we sometimes hear is that if you're getting a deduction for the machine and you're deducting the interest on the money you borrowed to buy it, you've got two deductions. one's much bigger than the other, but you got two deductions, and you might run into net operating losses, and you get a negative tax rate because you got two deductions for the same machine. That's negative tax rates. They're no good. This argument came out of the Treasury 20 or 30 years ago, and at the time we debunked it, but it came back. The initial error is that they forgot that when this firm gets its revenue and pays the owners or the suppliers of the capital, some of it is going through the company as interest to the lender, and the lender pays tax on that portion, and the company pays tax on the rest. So the interest is being taxed. The return on the machine that goes into interest is being taxed not on the business's tax form, but on the lender's tax form. It's still being taxed. There's nothing missed. They forgot the tax on the lender. That kept them quiet for about a decade, and then they came up with wait a minute. The Harvard endowment is tax exempt, and if Red Cross has some interest on its checking account, it doesn't have to pay tax on the interest, and some of you evil people out there have pensions, and you don't pay tax on that right away, and that gets invested in interest, and it's tax deferred. There's still a hole in the budget. If you have an IRA or a pension, and you retain the money, and it builds up over time, and it's withdrawn, what do you pay tax on? The whole thing, including the interest buildup. So the government's getting its tax later, but with interest. In present value, the government is doing okay. And if you happen to hit a big, really good investment, the government's getting kind of a windfall because it let you put the money into that investment and it's actually sharing in your good fortune. So that is of no concern. But what about the Harvard endowment and the Red Cross's checking account? Or whatever else Congress has made tax exempt? Well, you've made them tax exempt for some social purpose, one assumes, and unless you want to take that away from them, why should you penalize the borrower and by disallowing his business cost? Doesn't make any sense. The other thing to consider is that the Red Cross checking account is pretty narrowly circumscribed from year to year. It doesn't grow. And the Harvard endowment is committed to supporting Harvard. They can't suddenly say, we're not going to give you any money this year, Mr. President of Harvard. We're going to reinvest all of it because the rate of return on the stock market went up 0.5%. And we're not going to finance, we're going to finance a dozen new steel mills instead of paying the professors this year. That's awfully hard to argue. And they're not the marginal lenders for the expansion of the economy. So they don't set the interest rate. For all those reasons, you ought to ignore it. Now, if you do disallow the interest deduction as you do under a value-added tax, where it's a financial transaction and only real transactions are taxed, if you disallow the interest deduction for the borrower and you don't tax the interest received by the lender, you've taken the interest out of the tax system at both ends. That is equivalent to leaving it in at both ends. And either is an acceptable treatment of interest. Why is that? If interest is taxable, the lender knows they have to put in a couple of a percent to pay their tax. So let's say we have a pre-tax interest rate of 6%. The saver gets 6%, owes 2% to the government, and nets 4%. The borrower has an interest deduction of 6%. If it's in the 33 1/3% tax bracket, its after-tax interest cost is 4%. Now, what if we took interest entirely out of the tax system? Interest rates would fall to the tax rate on things that are already out of the tax system, tax-exempt bond rate. The pre-tax interest rate would be 4%, and the post-tax interest rate would be 4%. 4 and 4 are equal to each other, and top and bottom after tax. There's really no change going on, except that the Harvard endowment now only gets 4% interest on its checking account instead of 6%. So you haven't taken away Harvard's tax-exempt status, but you have lowered interest rates throughout the economy. And that's how you fix the hole in the budget without tampering with the tax-exempt status of Harvard or the deduction of a business cost by the borrower. Now, in the blueprint, they take away the interest deduction and continue to tax the lender. And that means now you've put the double tax on interest that you sort of have on equity finance. The ideal way of getting rid of the double tax is to remove it where it's double, not to install it where it's single and then use the money to lower the rate a bit. It turns out not to do a lot of economic damage, but it is a quirk in the bill, and it involves about 1/3 of the revenue gain. But it's something to keep in mind in case you suddenly find a big pot of money and can do without it. And I have covered this. Okay, now, last week we went over the difference between the income tax and the neutral taxes that don't have the multiple layers of tax on saving and investment. I mentioned there were 4 neutral tax types: the retail sales tax, the value-added tax, the flat tax, either the Hall-Rabushka variety or the Dick Armey variety, and the personal expenditure tax, which has a whole variety of names: cash flow, consumed income, Bradford, inflow, outflow, and so on. I'm going to show you how these are really all the same tax. They all tax income minus saving, which is consumption. But they tax it in different places and in different manners. We showed you a couple of weeks ago the deadweight loss from having a tax imposed, the triangle, and that's called the excise effect. One point I want to make is if you're going to have a VAT or a sales tax, it's better to have one flat rate. Some people or some countries try to make their VATs more progressive by exempting food, medicine, and children's clothing. And this is why you find some petite older women shopping in the children's section for clothing that looks so sophisticated you know no child would ever buy it, because it's a way of getting around the VAT. In any event, what happens is as you have different tax rates, you run into added costs. The deadweight loss from a tax rises with the square of the tax rate. Now, I've shown a dark triangle on the right illustrating the deadweight loss from a 1% sales tax. The more moderate color shows a 2% tax, and you can see it has the equivalent of 4 little triangles in it, and a 3% tax, as you move the rate up and the quantity down, has 9 triangles in it. That's what happens. And so if you have 2% tax on everything, you have 4 units of deadweight loss. If you have 1% on half of your items and 3% on the other half, you might be getting the same revenue, but the deadweight loss is 9 halves on the 3% and 1/2 on the 1%, half of each, and that adds up to a 5-unit deadweight loss instead of a 4-unit deadweight loss. Uneven taxes give you more deadweight loss than even taxes. At 1 and 2 and 3%, it's not a big deal, but when you have value-added taxes in Europe between 15% and 25%, and some at 0, you can see that you're going to get some distortions in what's produced. Just bear it in mind if you ever enact one, which it doesn't really look like you're going to, but if you did. Now, this is a comparison of how sales taxes and value-added taxes are collected and imposed. I'm going to start with iron and coal, the raw material. It's going to have $6,000 worth of sales to the steel mills and the auto parts companies. If we have a 10% sales tax at retail, there's no tax on the iron and the coal. But if we have a value-added tax, the iron and the coal companies pay $600 in tax for their sale to the next level up. The steel and parts companies might produce products that they sell on to the automobile manufacturers for $18,000. They've added $12,000 in value to the $6,000 in raw materials. That's the second column. There's no retail sales tax on the intermediate good, but they've added $12,000 in value added, and they will pay $1,200 in tax at 10%. They actually pay $1,800 and then get back a rebate from the Treasury of $600. That's called credit invoice. First you pay on all your sales, then you get back a credit for all the taxes that you had to pay when you bought the stuff from the other companies. And because you get that back on everything you bought from the other companies, including plant and equipment, it's expensing your capital costs, not depreciating it. China for a while had a tax system where their VAT only allowed depreciation recovery instead of expensing recovery. It didn't work well. They went to the European style where everything is expensed. The automobile company sells the car to the final consumer for $27,000. It's added, did I make a mistake in arithmetic? Yes, but in any event, no, I'm sorry. It paid $18,000 for the parts. It sold it for $27,000. It's added $9,000 in value at the automobile stage. A sales tax is imposed here because the automobile company is selling the car to the consumer. It's the final sale. So they pay 10%, $2,700. Under the VAT, they've added $9,000 in value, they pay $900. Well, actually, they pay $2,700 and then get a rebate for the $1,200 they paid from the time before. So they are paying a net tax of $900. And what's the total of those three VATs? $2,700, the same as the sales tax. But you see, it's collected in stages instead of all at once at the end. The consumer ends up paying the cost of the VAT because, of course, the company has to take that in and give it to the government. But you've collected it in stages in one case and at the end in the other. The reason for doing it in stages is partly historical and partly for administrative reasons. If somebody cheats along the way and you don't get an invoice that shows that you paid VAT on parts, you still have to pay the full tax to the Treasury on the end, and the next layer up makes up the difference for the tax cheat. So administratively, the Treasury can push some of the cost of enforcement onto the business community, which makes darn sure it gets an invoice, which is a paper trail showing that the firm below it should have paid tax, and if they didn't, they're in trouble. The other way of doing the VAT is simply to say, all right, here's your sales, and here's your cost of materials. Take the subtraction difference and only pay the tax on the difference, and don't send the full amount in and get a rebate, just pay the tax on the difference to begin with. That is called a subtraction method VAT. The blueprint behaves that way for capital earnings. The difference on the blueprint is these taxes fall on the labor content. The blueprint tax doesn't fall on the labor content. It's only doing it for the capital side. So they have a cash flow VAT-ish kind of tax for business in the blueprint, but only for the capital income, not the labor income. The flat tax is an illustration. It's sort of like a VAT, but it's also sort of like the blueprint. The business pays the tax on all of its sales minus all of its purchases and less all of its labor. The labor taxes are put onto the individual tax form where you have the labor income, you take a large family allowance off of that, and you pay tax on the remainder. So whereas the VAT taxes capital and labor income at the business, the flat tax taxes capital income at the business and labor income on the individual form. All returns to capital are taxed at the business, so there is no tax on interest, dividends, and so forth. On the individual form, it's prepaid at the business before the income is distributed as dividends or reinvested for capital gains, or interest is paid out. The interest is out of the tax system. My favorite tax is the inflow-outflow tax. Everything is passed on to the individuals as if you were a pass-through entity. You put down your income on the top line. You subtract your saving during the year, which your bank and broker will tell you how much you put in as opposed to how much you took out. That could be a negative number. That's your basic income. You take away whatever itemized deductions are allowed, and then you take away a personal allowance, and then you pay tax on the remainder. Very simple. It doesn't have as many deductions removed as in the flat tax because the author of this tax plan, my mentor Norman Ture, said, look, if the government's taking money from me and giving it to somebody else, I don't get to consume it. So he would deduct all state and local taxes, and he would deduct payroll tax as well. And if you give money to someone else, it's a deduction, charity, they pay tax on it, but you made them tax exempt, so much the better, all right. And qualified tuition would be expensed. And you would have some deductions, not as many as under current law, but you would have some. One of the reasons Norman put this provision in, if the money went to somebody else, I get to deduct it, and they get it on their tax form. You see, he was married 4 times, and he had alimony 3 times, and you see what he was saying. And then there's saving. If you put money into some savings institutions, took money out of others, you'd get a 1 number at the end of the year. It would say, this was your net saving for the year, subtract it. The handout I gave you from the President's panel, they took all of these concepts into account, 2005 Treasury. They came up with a simplified income tax plan with fewer deductions. Most of them turned into credits, so there's a flat amount per family instead of having it vary in value by the amount that you got because of your tax bracket differential. Reduce the number of tax brackets and simplified the income tax. They also had a growth and investment tax plan. It's sort of halfway between a purified income tax and the cash flow tax I just showed you. The differences were they had accelerated depreciation and expensing for a lot of items, and they removed the interest from the tax system, but not the capital gains and the dividends. The savings was given Roth treatment. They consolidated all those many savings incentives into a Roth-style lifetime plan where you paid the tax up front and then didn't tax the returns on it. But if you had your own shares in an ordinary account, you would pay tax on the dividends and the capital gains and the interest on the stuff outside of that plan. They also talked about a full-blown cash flow tax, which looked like the one above that I showed you, but with graduated rates. They also talked about VATs and national retail sales taxes. But they compared them all side by side. Now, the charts involved, as you can see from the handout, are so detailed you couldn't possibly put them on a television screen here. But if you want to take a look at them over time and see what they did and get that book, which is that thick, off the internet, please do so. It shows you that these ideas have been percolating for many decades and have been carefully thought through in a number of ways, which is reflected in a couple of recent bills. The Camp plan looked very much like the simplified income tax, and the blueprint has a lot of features that you find in the growth and investment tax plan. So this is the intellectual background for these pieces of work, which have been very carefully thought through by the committee. Now, does all of this matter? Many countries do have better tax systems than we do. Here's one of them. They have a tax on wages and salaries of either a graduated rate that ranges from 2 to 17% with deductions, or if you want to give up your deductions, you can pay a flat 15% rate on your gross wage. 15% flat tax, sort of like the Army plan. It has no deductions for saving, but like a Roth-style IRA, there's no tax on interest, dividends, or capital gains. So all saving gets the sort of treatment we only give in a Roth retirement account. So that's one of the requirements for tax neutrality. It has low corporate tax rates. It has a small stock transfer tax, which is small, but they have a big stock market. They have a few excise taxes on liquor, petroleum, and tobacco. No estate tax and no tariffs. Any guesses? Who? Any guesses who? By the way, you're looking at their only natural resource, their harbor. Close. Hong Kong. Let's take another country. They have a VAT for most of the national government expense. The income tax doesn't go to the national treasury. They have an individual income tax at graduated rates. Most interest and capital gains on stock trades are tax exempt, at least on their own country stock market. They have a corporate tax rate of 25%, which is about the OECD average. By the way, they're in the process of eliminating the capital gains on stock held for a longer period of time. Their dividends on home country stock are half exempt, reducing the double tax on corporations. They have no estate tax. Payroll taxes are deductible and benefits are not taxed. That's amazing. They don't tax the payroll tax portion of the labor either when you first earn it or when you take it out later as social benefits. That's kind of a double deduction. It's not neutral, it's a subsidy, but there you are. It's sort of like an earned income tax credit, if you will, against the income tax. Okay? Any guesses? Oh, somebody take a wild guess. Something. New Zealand. They did adopt a VAT not long ago, you're right, and they did lower their individual tax rates, but no. However, you are on the right ocean. Here's a picture of their largest city, 1990. Any ideas? Here's a picture of that same bulge in the river 27 years later, after their tax reform. Anybody? That is the city of Shanghai. Now, China did do some other things besides its tax reform. They sort of legalized private property and got out of the way of market activity. But it does go to show you that some of these things can matter. You have many nations around the world that are doing better jobs with their tax system than we are. And some of them are growing very rapidly. And we could recapture some of that growth differential if we improved our tax system. So I hope we can give some very serious consideration to it. Now, I haven't gone this time into monetary policy. The Fed made some major announcements yesterday, and I need a few days to think about what they mean. We also want to go over the differences between our model and other models. I mentioned earlier this afternoon that we would show a lot of growth from expensing and a corporate rate cut, less so out of the Joint Tax Committee or the Treasury because of their concerns about the Federal Reserve and monetary policy and crowding out. So we're going to talk about those differences next time. And we're going to go over our modeling of some of the major tax bills from Kennedy through the 2003 tax bill and show which provisions added how much to our projected growth as a result and how much they cost, and demonstrate that different types of tax changes have different outcomes. This will also give you a little clue as to why we think the 2007 and 8 financial crisis occurred and what policies could have been done differently to prevent it. One example I will give you is another Asian situation, Japan, which had a major tax reform that looked like our 1986 tax reform at the end of the 1980s, and as I did predict at the time, went into a generation-long depression. Unfortunately, as a Treasury official at that point, I couldn't speculate against either the yen, and there was no way to short the Nikkei average or I would be a billionaire, except I would have been too chicken to do it. But in any event, these things do matter, and they can give you generational consequences. So we'll get into that next week. Thank you for coming.